Hello folks, welcome back. This is our midweek review and commentary for the ICT Mentorship, April 21st, 2021. Alright, here's their dollar index daily chart. And we had delivery on price as I was expecting and outlined. We had this imbalance in here, buy side imbalance, sell side inefficiency, bullish order block, sell side liquidity pool here, and price accumulated back in this old fair value gap there. Accumulating what? Short positions, displacement to the downside, pause before we get down into the sell side liquidity, and then attacked it on Monday aggressively. We traded into the order block here. I mentioned should we trade there, we would possibly see a return back up into this area in here. We had that as well. Now we also came back up inside of this sell side imbalance, buy side inefficiency. So we did trade up into that initially intraday, bumped the blunt end of the down close candle here, which is your breaker. It's the lower close price. Look at the closing price up here. Okay, watch right here. The closing price on this candle, 91.42. The closing price here is 91.44 and 2 pipettes. So this one's slightly higher than that one. So this is your breaker. Extend it out in time. Right there. The high comes in at 91.42 and 8. And again, the close here is 91.42 even. So it's bumping that and does not get up to this candle's closing price. Okay, so there's a difference in knowing what you're looking for the breaker. It's not a supply and demand zone, okay, that we're working with. It's a very specific price level with a very specific logic around it. The market trades up to that level there and comes off of it intraday. Now, what I'm going to be watching for, and I'm going to counsel you to watch as well, is do we continue to move lower? And if we do, we're going to be working inside of this imbalance on the buy side imbalance, sell side inefficiency, and sell side liquidity pool here. If we do trade down here, then it'll be interesting to see how we do it with large ranges and sudden movement, or is it just a small little cascading event where it takes multiple small candles to do it. That's kind of like what I'm trying to determine. And the reason why it's important, or even why it should be even considered a study, or why is it even relevant? Well, if it runs quickly for it, okay, if it runs quickly for it, it's doing it with the likelihood of it possibly reversing and going higher. Okay, if it just keeps stair-stepping lower, 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 then what that's doing is it's slowly encroaching on the sell side liquidity, and they don't want the traders to take those stop losses off, because if they get spooked, in other words, the longs get spooked out of the marketplace, that might also remove the liquidity resting below this low here. And ultimately, how we trade into this area, if it's small ranges, okay, each day getting down into that, then what I'm thinking is they're only doing that slowly to build up a quick run to attack that low and that low. So in here, we're watching to see if we get down there. Now, it could altogether trade higher, and in that case, we could have just moved below the sell side liquidity here, absorbed all of that, and the market wants to come back and maybe trade up into this area here. We do have small little imbalances here that might be useful. We have a bearish order block there as well, which is also basically close to the old fair value gap that we had on our charts. I think it's rather bullish if we can get back through this candle. Okay, so if we trade through 91.88, because the high is 91.87 and 8 pipettes. So if we trade above that, that to me suggests that we're probably creating a deeper retracement that takes the sell side out, accumulates it to long bullish order block, and then it might see continuation on the upside. I don't see that at the moment. Okay, gun to my head, I'm looking for the market to trade down into this area here and higher prices on foreign currency. All right, here's the dollar index on our hourly chart. You can see we traded back up into, not entirely, but at least consequent encroachment of the sell side imbalance, buy side inefficiency. And we trade up into here, hit it, and that's that breaker on the daily level. Okay, look at the sensitivity there. Beautiful. Hits it, quickly retraces lower, attacks a short-term sell side liquidity pool. Now there's nothing really in here that needs any special consideration except for this little fair value gap, this bullish order block overlapping, and we have relative equal lows. So I want to see it dig into that, and then if it overtakes it and goes below this low, that really indicates bearishness. Plus we have an optimal trade entry from this high to this low, which we traded up into with that breaker. All right, here is the 15-minute time frame on the dollar index. And let me scrunch this up a little bit. We have the sell side imbalance, buy side inefficiency, and the premium high and the discount low. That's these levels here respectively, which is also converging with that daily bearish breaker. See the 91.42 level here, the solid line? That is that daily bearish order block. So carrying over our higher time frame PD arrays is crucial in understanding the lay of the land, if you will, to navigate these intraday charts. It isn't always a lower time frame PD array that turns the marketplace. You have to be aware of what's on those higher time frame monthly, weekly, and daily, and even 4-hour charts. And by having that, it gives us the highest probable impulse, where it just sends the market one direction or the other. Notice the convergence of that bearish daily breaker and the premium high of this SIBI. So we went completely up into it, closed it in, and hit the bearish daily breaker. Then displacement, attacking relative equal lows, sell side liquidity, hammered it beautifully. So we had a market reversal profile in New York at a higher time frame premium array. We have relative equal lows in place still. So we have sell side liquidity there, and we have sell side liquidity there. So we'll be watching to see if it comes up into this area here, maybe close that in entirely. Doesn't need to, because we have a breaker here, and we have the breaker here. So there's layered resistance in here. It doesn't necessarily need to trade up in here, but I'd like to make an attempt a little bit more than this. I don't like these flat-ended turning points that roll over. I don't like them at all. I like to see them at least create like a jagged punch above a previous short-term high and then reject something like that. Something to this effect here, where it goes up and says, nah, I can't handle that. I can't hold on to that level, and this keeps going lower. That's kind of like what I'm looking for in here, because we're in two different potential bearish breakers. And again, high, low, high, and high, low, higher high. So both of these here are bearish breakers, and we're basically trading in close proximity to, well, this one obviously, but this one here we're real close to it. Didn't quite get to it yet, in my opinion, but when it does, it might be sensitive to the effect that we see price drive lower. And maybe this is in fact one of those real good old-fashioned bear flags. But I like this liquidity here. I think that's where we're most likely going to reach for the dollar over the coming day or so. If not, and we don't break above this high here, then we might need to get into next week if we consolidate the rest of the week. But right in here is where I'm focusing. That means I'm bullish on foreign currency near term. All right, here's the euro dollar daily chart, and you can see we have rallied higher, closed in this sell side imbalance, buy side inefficiency. We're inside of a bearish order block, but I don't see that one as a kind of line in the sand that, you know, should ultimately create the high and send it lower. I think that we're going to want to get up into here. We have buy side liquidity here. We have another sell side imbalance, buy side inefficiency, and it may require to go deeper there. So again, it's kind of like a little bit more lower in dollar and a little bit more higher in euro, and it's into this area here and the buy side liquidity that might be attacked. We have a small little fair value gap in here. We traded down into that. Didn't quite close it in, but that's good enough for us. We'd like to see a little bit of that left over and not completely closed in, and it'll act like a breakaway gap. And we'll see if it wants to drive higher, attacking here and closing in the remaining balance of that. Initially, I told you we would be running up into this level here. The dollar index, I'm looking for that lower price, and on euro, we might pump a little bit higher in here. Now, what changes that? What changes the scenario where this likely goes lower and work inside of this level here? Well, it would need to get below this down close candle and then come back up into it and hit it, and this would become like an inversion level. So if we trade down through it and come back up anywhere in here from the close or the low, okay, any one of those two levels, if it hits that and starts to show some, I guess, increased volatility or speed that wants to go lower, then that would set up the run through this area here of consolidation, and then we would reach into here. I don't really think it needs to do that, and I like the fact that we dipped into this fair value gap today and we've shown some willingness to come out of that. I like that. We had the Bank of Canada rate announcement today. That was pretty eventful for loonie, and loonie is the currency for Canadian dollar, so that's the name for it. It's not a nickname I've given it. I get a lot of questions. Why do they call it cable and why do they call it fiber? You can actually Google that and find out. It's not that big of a deal. But dollar CAD was the event for today, and all of those types of things. And whenever there's a bank rate announcement, it's important to note that even though it was specific to Canada, all of the interbank relationships with that currency and dollar still will be affected. Every time you have a bank rate announcement for any country, that is not limited to just that country. It goes through the dollar crosses, and you'll see reverberations through euro, you'll see it in cable, and you'll see it in Swissy, and you'll see it in Japanese yen, Australian, and New Zealand. So you'll see all of the dollar crosses affected whenever there is a rate announcement or a change, and if there's a lot of volatility. Like today, we saw a lot of volatility in Canadian dollar. That also caused a turning point in the marketplace for relatively all of the currencies. So be mindful that when you're looking at your economic calendar, and I don't include that anymore because of the time element, because it's something you should already know how to do and take note of. I don't need to do that every single week for you. And independent mind is what you should be trying to develop here. But any rate announcement for any currency or country, that will always have ripples through every dollar cross. Okay, whether it be the ones that I talk about or even pairs that I don't necessarily talk about a lot. So I'm thinking that with all of that in mind, and the fact that we dipped into this imbalance here, I like the fact that we didn't come back down here and touch this down close candle like most folks would like to see it trade down in there, because they understand a little bit about my order block theory, and if it comes down into that, they expect it to trade higher then. I, in this case, don't want to see it trade down there. I want to see it leave this little bit of a opening in that gap between this candle's high and this candle's low. There's a small little gap there. I'd like to see that remain. And that to me indicates that it doesn't need to go lower. The algorithm is in aggressive mode that wants to take out this high. If it should take out this high, then we're focusing here and completely closing in all of this. And how we trade there, again, is very similar to what I was announcing when I was talking about the dollar index, how if it trades lower, is it going to be done in multiple short little ranges, or is it in real big ranges in a speedy run? Because if it does it in like one candle up, that to me means they're running it up here just to close this in, and then euro might in fact change directions then. That would also give me the reason to want to go short. But right now, I'm still expecting higher prices in euro, lower prices in dollar. All right, here is the euro dollar hourly chart, and you can see we've taken out sell side liquidity here, traded back into the buy side imbalance, sell side inefficiency here, which is basically what we were looking at on the daily chart, but this is a much more refined point of view. Trades into it here. We'd like to see it leave some of it open. It did that. We rallied up. Now this could be, again, kind of like the mirror image of what I was talking about on the dollar index, where it has a potential bear flag. I teach you how to look for false flags in this mentorship. In this case, I think it might actually be a legitimate one, and that's because I'm siding with the institutional order flow on the higher time frame, and the willingness to want to go higher makes more sense in here than that of going lower. Now, obviously, if this takes this low out, then we'll be looking for a complete closure here and then attack the sell side liquidity. And then we have this over here. I don't see that now. I think it's going to go higher. And I like this little area here as well. So that might be something on the near term that if we trade up into that level, closing that little imbalance and hit the order block, notice the butt end of that opening price here. Look at the opening price right over here. Okay, focus there. The opening price is 1.20609. And then we have the fair value gap here, which is basically an overlap of that same price. So if we trade up into that, it might be sensitive there. Okay, so it could trade up bullishly, hit this area here and satisfy with just running there. And if it breaks down, we'll have to cross that bridge should it get there, because it might in fact not go there. And it's always potentially probable. It could be what happens. I could be wrong, but I have to tell you what I think is going to happen, and that's what I think is going to happen. I think it's going to at least go higher from here. But I'm watching this level here. So what does that mean when I say that? Am I giving myself an out to say, see, I was right, ha ha ha? Is that plan A, plan B? No. It's me saying right now, if I had a gun to my head, if I was to tell you buy or sell, I'm saying I would be more inclined to buy than to sell short. And then I would wait for it to run up into this level here. And then I would be taking well, since we're trading into Thursday tomorrow, I would be taking 50% of my trade off there and leaving the remaining 50% on to see if we can take out that high. Then I would take something out just a little bit above that, and then basically split the last remaining 50% into quarters. So I would take 25% of the remaining balance off above this high, and then as we stair step higher into that daily level I was outlining before we dropped down to the hourly chart, I would be taking partials along the way, and then finally the smallest piece being at where I think it's going to go, because we're so late in the week. Whereas if we were in, say this was Monday and not Wednesday, then I would take less off here, not take anything above that high, and still look to take partials higher as we worked into that daily buy-sell liquidity pool and imbalance that may still be a target on the upside. So there's a contrast there, why I would do one thing over the other. Again, that's a teaching. Okay, it doesn't always have to look like candy and taste sweet. If you're casually just watching my videos, you're going to miss a lot. But if you're listening to what I'm saying, I'm giving you logic. I'm giving you reasons why I would expect something to unfold in price. I'm also telling you what I don't want to see. It does not mean plan A, plan B. It doesn't mean I got the market bracketed and whatever happens, I'm going to be able to look smart. No, I only remind you, if I'm wrong, I say, look, I got that wrong. Does it happen a lot? No. I say, this is what I think is going to happen. Does that happen most of the time? Yes, it does. So I tell you why I'm thinking what I'm thinking, using the chart to guide that lesson or that school of thought around that underlying premise. And then I also talk about what I don't want to see and why that would be impactful, because it gives you, again, my experience that you don't have. None of you have the level of experience I have. So to keep you from having the pain and the agony that I went through, I'm telling you what you wouldn't necessarily see or be able to anticipate in price, even on the adverse side. See, when you're developing, it's easy to get pip drunk, and that means you're only looking for your outcome to pan out. And that's why it's so painful. When it doesn't pan out, you get mad, or you're ready to quit, or you go into revenge trading and you blow your account. I've had students do that this year because they did not listen. The last group that just started, we had a huge number of people come in. I've had 3 people email me since the enrollment started for them, and they said they blew their account. And my question is, why? You weren't even supposed to be trading with live funds. You don't even know what you're doing. So what you're saying is I want to go pick up that loaded gun, take out all the bullets except for one, spin the chamber around, click it closed with my eyes closed, and then put the gun to my head, cock the hammer, and pull the trigger and see if I can survive. That's the equivalent of what you're doing. And that's what I was trying to avoid if you just would have listened. And some of you are still probably doing this and you just haven't got that round in the chamber yet. But give it enough time and you're going to blow your brains out. And you're going to blow the account. You're not going to want to trade. You're not going to want to stay here and learn. And you're not giving yourself a real chance to learn how to do this because you're impatiently trying to chase money. And every single trader that does that, every single trader that does that blows up. They fail. They never succeed. It always happens that way. It never, ever, ever has a different outcome. And it's never the positive outcome that you want. You will always self-destruct doing that because you're trying to do something you don't know before you're supposed to be doing it with live funds. You don't know why you're doing it. You don't know how to determine you did it wrong and get out. You have no idea how to manage a trade. You have no idea how to anticipate when it's going to happen. You don't know what candle you're buying. You don't know what candle you're selling. You don't know how to trail your stop loss. Do I need to go any more than this? Now I'm saying this for your benefit. I'm not trying to belittle anyone. I'm not trying to talk down to anyone. But I take my time to make these videos with a result in mind for your progress and your development. It's not to say, hey, look at this. This is a trade. Now, because I told you I think that the euro is going to go higher, go out there and put some trades on and go long. That's not what I'm doing. I'm trying to teach you without any influence by way of money to entice you or scare you. Greed's not going to have a hand in your development, and fear is not going to have its hand in your development. You're indifferent to the result. That's how you learn. That is how you learn how to read price. Period. If you add any money to it, you have now invited two of the worst enemies for a trader. That is fear and greed. And if you listen to me, I'm telling you how to keep them at bay and give yourself a chance to read and learn price. Once you know how to do that, then you can go in with a very small amount of money. And then you can beat those two demons. Because you'll have experience and say, okay, even though I'm using a live account, and even though I might lose, and even though this trade might not look like it's panning out right now, I'm going to stick to the rules. And then when it starts moving in your favor, you will have leaned on the experience that you gleaned through indifference and not the scorecard result of being right because you made money or being wrong because you lost money. If that's how you think, you're going to have trouble trading. You're never going to get where you're trying to get. You might have hit and miss results, but ultimately you won't have longevity and you're going to fail because you're trying too fast to get to money. And that is the easy part. The hard part is what I'm telling you to submit to. If you do this, that is the derivative. That's the end result is consistent profitability. But you have to go through a lot of boring stuff. You have to learn a lot of theology. You have to learn a lot of theory and things that just don't feel good to sit through, like this video. These are the videos that make the successful students I have. It's not the ones that are buttered up on charts, okay, sugar-coated with all the annotations, real dark and rich. You can see it and print them out and make books on Amazon. It's the lessons and listening to the logic of why I'm telling you what I'm telling you and focusing on the chart at the moment, right now. It's not, here's what happened over here and that's all we talk about. I'm telling you what's going to happen before it happens, and I'm telling you why it should take place. That way it narrows your focus. It keeps you focused on the most likely outcome in price delivery. So we have the market trading in here. It looks like it wants to run above the buy side liquidity here. And there's a small little fair value gap, as I mentioned, on the hourly chart. That's it right here. It's a smaller little refined version of it. Buy side liquidity here, relative equal highs, and then right in there. Now, the fact that we have a high, low, and a higher high creates that breaker. So we might trade up into that. It might give us a little bit of resistance there. But all in all, I think it's more likely to go higher than it is to go lower based on what we see in the marketplace right now as the chart appears at the moment. On the annotation side, you can see that we had the London Open trade lower. We have optimal trade entry here. Trades up into the last up close candles, which is your bearish order block. Optimal trade entry in London trades lower. New York market reversal profile. Market trades higher, attacking the buy side liquidity here. And it looks like, again, just the beginning stages of another measured move type thing. So if you take the low to the high and add it to this low here, and what I'm showing you here is a standard approach to applying swing projections just using classic price patterns like a bull flag. We have a low to the high, and then if we take that range and we add it to this low here and project it up. So we have here, here, here. It also takes us up into this level here. So we have all of these ideas that overlap with the likelihood that it could go higher. And again, that's assuming that the dollar index does in fact go lower. And I think that's going to be it for this one. Let me go over here. Yep. We did a run 30 pips above this high here, and then we had the breakdown with the breaker. We hit it. Cleared up the sell side liquidity here. The buy side imbalance, sell side efficiency. This is the premium high, discount low of that. We didn't get down entirely to it. We did get to the consequent encroachment of that midpoint of it. And then we had this reaction here, which again, I like that. I like the fact that we did not completely close in that imbalance. So I want to see it continue higher and lower on the dollar. Let's go to the cable now. All right, here's the British pound versus US dollars, our daily chart. And we have these relative equal highs in here. I said that we would be trading up into that. And if we get above that, we'll be looking to close in this area here. We did in fact have that happen, and we traded up into it yesterday. And today we had a little bit of a retracement. So we're back down inside of this buy side imbalance, sell side inefficiency. And we have the breaker. Okay, so we have this last up close candle extended out in time, traded down to a bullish breaker. So we're going to anticipate continuation on the upside and aim right in here. So again, that's in alignment with what I'm expecting on the bearish dollar. All right, here's the hourly British pound versus US dollar chart. You can see we have a nice little run up in here, and we traded down into it. We had 1, 2, 3, 4 times dug deeper, and now we have the market consolidating right here. I don't like the fact that there's really anything except for these relative equal highs here that would be easily targeted, except for this high here. So what am I saying? I'm suggesting that even though this is done well in terms of digging deeper, attacking sell side liquidity, it could go lower and take that one out. In other words, go lower than this before it ultimately turns. And euro can go higher as that happens. Okay, so just be mindful of that. I'm not bearish on cable. I'm just suggesting to you that this low could in fact be taken out again and before it goes higher. If we take out this low here, then obviously I'm probably wrong in regards to a bullish cable. And if it takes out this low here, then we're going to be attacking here and here. But I don't see that. I'm siding with bullishness, but not against the idea of it cleaning out this low once more and then going higher. Let's drop into the 15-minute time frame. All right, here's the 15-minute time frame for the British pound versus US dollar. And again, you can see the buy side liquidity pool here I mentioned on the hourly chart. There's relative equal highs. That to me is the next short-term premium array, but I'm not looking for it to go there to go lower. I'd like to see it obviously tag that and go into a more aggressive run to take out these relative equal highs. These two down close candles here, we dug into that as a bullish order block after taking sell side liquidity out. So overall we had London, then New York market reversal profile, then it trades up. It's stagnating in here, which I don't really like that. And again, it's another reason why I said that I would not be against or put off by it going one more time, going lower. I just don't want it to grow aggressively bearish as it does that. Like if it goes down, touches the low, or just goes by a pip or so below it, and then starts to rally, then I would expect this to be just a speed bump and then attack here. But I'm more bullish on euro than I am on cable. But just know that I outlined on the daily chart what I would look for it to reach up to should in fact we see price going higher. So in short, this pair is an observation pair only. It's not a trading pair for right now. The setup isn't as nice as it is in euro. and this pair could be manipulated to work the cross Euro Pound. And that, my friends, is going to be it for the Wednesday midweek review. And until talk to you next time this weekend, be safe.